The market isn't a puzzle of numbers, patterns, or economic forecasts, it's a mirror. It reflects every trader's beliefs, fears, and expectations in real time. Each price movement is nothing more than a collective emotional response to uncertainty. Yet, beneath all that noise, there's always a direction, a dominant force quietly pulling everything along. That's the big trend. Most traders can't see it, not because it's hidden, but because they're too caught up reacting to every tick, every candle, every flash of movement that seems important in the moment but means nothing in the bigger picture. There's a simple trick to identifying this underlying current. One so simple that most will dismiss it. The trick isn't found in an indicator, a signal service, or a complex algorithm. It's found in perception, in how you interpret what the market is showing you, not what you want to see. Most traders look for confirmation. They want the market to agree with their position. But the market doesn't confirm, it only reveals. When you learn to observe rather than react, to listen instead of predict, the big trend starts to stand out like a mountain in the fog. Think of the market as a flowing river. Every minor retracement, every false breakout, every sudden spike, they're just ripples. The current underneath, though, never lies. If you try to fight that current, you'll exhaust yourself. But if you align with it, everything becomes effortless. That's the one simple trick: alignment. The ability to align your perception with the market's reality instead of your own expectation. Most never get there because they're conditioned to seek certainty. The irony is that certainty only exists in the flaw of uncertainty itself. The big trend isn't always visible on the small time frames, and it doesn't care about your entry signal. It reveals itself through consistency, not in price, but in behavior. Every market, no matter the asset, displays its true intention in repetition. Repeated patterns of strength, repeated failures to break certain levels, repeated reactions to certain events. These are not coincidences, they are expressions of collective psychology. And when you can step back, detach from the need to be right, and simply FC, you start to identify that rhythm effortlessly. The one simple trick then isn't something you apply to the market, it's something you apply to yourself. It's the act of shifting from analysis to awareness, from thinking to observing, from chasing to aligning. When you can do that, the noise fades and the trend becomes obvious, almost embarrassingly obvious. It's been there all along, waiting for you to stop forcing your view and start understanding the markets. The big trend doesn't reveal itself to the one who studies the most. It reveals itself to the one who listens the best. Perception over prediction is the dividing line between those who understand the market and those who are endlessly at war with it. The majority of traders operate under the illusion that the market can be predicted through formless patterns or data. They believe that if they analyze enough variables, if they find the right indicator or perfect setup, they can forecast the next move. This obsession with prediction is born out of a deep psychological need for control. Humans crave certainty, and the market, being inherently uncertain, exposes the fragility of that craving. When traders try to impose certainty on an uncertain environment, frustration becomes inevitable. Every loss feels personal, every unexpected move feels like betrayal. But the market doesn't betray anyone, it simply exists. It moves, fluctuates, breathes. It reflects the collective perception of all participants, not the private expectations of one individual. To truly identify the big trend, perception must replace prediction. Perception means seeing what is rather than what you want to see. It's a shift from control to awareness, from manipulation to observation. Most traders are not perceiving the market, they're projecting onto it. When they look at a chart, they don't see price action. They see their fears, their hopes, their biases. Every candle becomes an argument for their position. This blindness creates conflict, and conflict clouds perception. When your emotions are tied to an outcome, your ability to perceive reality collapses. You start filtering information, focusing only on what confirms your beliefs and ignoring what contradicts them. This is why even when the big trend is obvious, most traders can't see it. They are too emotionally invested in being right. Perception is neutral, requires detachment from outcome. The trader who perceives doesn't need to predict. He recognizes the flow of probabilities. The market isn't a crystal ball. It's a feedback system. Every tick, every volume spike, every reaction to a level provides information about the collective psychology driving price. The perceptive trader reads that information without judgment. He doesn't assign moral value to up or down moves. He doesn't need to know what will happen next. He needs to know what's happening now, and that awareness, paradoxically, gives him a kind of foresight that prediction can never provide. Because when you are fully aware of what is, the next likely development reveals itself naturally. Prediction is rigid. It locks you into a single version of the future. When you predict, you form an attachment to that outcome, and attachment breeds resistance. Every moment the market deviates from your expectation, tension builds. That tension clouds judgment and distorts perception. You stop seeing the market's message because you're too focused on defending your belief. The more attached you are to being right, the more likely you are to be wrong. Perception, on the other hand, is fluid. It adapts moment by moment. It flows with the market's rhythm, not against it. The perceptive trader isn't trying to win an argument with the market, he's listening to it. When you learn to perceive instead of predict, you stop forcing trades. You no longer chase setups out of impatience or fear of missing out. You begin to wait for clarity, not in price, but in behavior. You recognize when the market is balanced, when it's trending, when it's transitioning. You can feel momentum, not because of a moving average, but because you've attuned yourself to the market's energy. This awareness doesn't come from intellect, it comes from presence. Prediction operates from the mind, perception operates from awareness. The mind wants patterns and explanations. Awareness accepts uncertainty without needing to define it. Every trader has experienced moments of pure perception, those rare times when decisions feel effortless, when every move seems obvious. That's not luck, it's alignment. In those moments, you're not predicting. You're responding to what's unfolding without resistance. You're in sync with the market's rhythm. But because most traders can't maintain that state, they return to analysis and overthinking. They try to recreate that feeling through logic, not realizing that logic was never the cause. It was the absence of interference that allowed perception to operate clearly. To cultivate perception, you must strip away your need for certainty. Certainty is an illusion that traders pay for with losses. The market rewards flexibility, not stubbornness. The more you accept that you don't know what will happen next, the more clearly you can see what's happening now. The irony is that when you stop needing to predict, your ability to anticipate improves. This is because perception is rooted in probability, not desire. It recognizes tendencies, not absolutes. The market doesn't move randomly. It follows the psychological tendencies of participants: greed, fear, hope, panic, and relief. These patterns repeat endlessly, not in exact form, but in structure. Perception sees that structure even when the form changes. Developing perception requires quieting the inner noise. Most traders listen to their thoughts more than they listen to the market. Their internal dialogue drowns out observation. Every trade becomes a debate between what if I lose and what if I win. This constant chatter blocks the subtle signals that the market constantly emits. The perceptive trader, however, listens with a quiet mind. He's not detached emotionally because he doesn't care. He's detached because caring too much blinds him. When you can look at the market without emotional interference, you begin to sense direction, pressure, imbalance, not as data points, but as energy. Charts stop being charts, they become living expressions of crowd psychology. Each candle is a pulse, each trend a heartbeat. You begin to notice how certain levels attract or repel price. You see how momentum builds and dissipates. These aren't predictions, they're recognitions. You're recognizing the market's state of being. And when perception is clear, action becomes effortless. You don't hesitate, you don't overanalyze, you simply act in harmony with what's unfolding. The biggest obstacle to perception is fear. Fear of being wrong, fear of missing out, fear of loss. Fear narrows your focus. It forces you to look for safety rather than truth. And in the market, safety doesn't exist in the way most imagine it. There are no guarantees, no perfect setups, no systems immune to loss. The only safety lies in clarity, in perceiving the truth of the moment and acting within it. Once fear dissolves, perception sharpens. The market becomes transparent. You stop fighting it because you finally understand that it was never your enemy. It was your mirror, reflecting back the quality of your perception. When perception replaces prediction, your relationship with the market changes fundamentally. You stop trying to conquer it and begin to cooperate with it. You realize that success in trading isn't about control, but about understanding. It's not about predicting where the market will go, but perceiving where it already is. And the clearer your perception becomes, the more naturally you align with the big trend that was always there, quietly moving beneath the surface, waiting for you to see it. Alignment with market flow is not a technique, it's a state of mind. It's the point where the trader stops imposing his will on the market and starts moving with it. Most traders approach the market as if it's something to be conquered, a challenge to outsmart, an opponent to beat. That mindset creates resistance, and resistance disconnects you from the market's natural rhythm. The market is a dynamic system. It's not static, not mechanical, and not personal. It doesn't care who you are, how much you know, or how many years you've studied. It moves according to collective behavior, not individual intention. The moment you try to control or predict that movement, you create tension between what the market is doing and what you want it to do. That tension blinds you to the flow. Alignment dissolves that tension. It's not about forcing outcomes, it's about synchronizing perception and action with the reality that's unfolding moment by moment. To align with market flow, you must first understand what flow means. Flow isn't about direction alone, it's about the energy that drives movement. Every trend, breakout, or consolidation is an expression of energy. This energy comes from the collective psychology of all market participants: buyers, sellers, institutions, and speculators. Each one reacts to information, emotion, and expectation. The result is a pattern of rhythm and tempo, expansion and contraction, momentum and pause. The flow is always there, shifting between states. When you're aligned with it, you feel its pulse. You sense when pressure is building, when volatility is rising, when momentum is weakening. It's not intuition in the mystical sense. It's awareness sharpened by observation and detachment. Misalignment happens when you operate from ego instead of awareness. Ego wants to be right. It wants to predict. It wants to prove that it knows more than others. Ego trades from fear and pride, not from connection. When ego is in control, you'll find yourself buying when the flow is slowing, shorting when the trend is reversing, holding when the energy is dying. The ego doesn't listen, it demands. It demands that the market justify your decision. But the market owes you nothing. Alignment begins when you stop demanding and start observing. You let go of the need to be right and replace it with the intention to understand. A trader in alignment doesn't fight pullbacks, he reads them. He doesn't panic at volatility, he sees it as breath. When the market expands, he moves with it. When it contracts, he waits. His patience is not passive, it's intelligent timing. Alignment requires rhythm, the ability to adjust to the market's tempo. If the market is fast, you move lightly. If it's slow, you hold your energy. You're no longer chasing profit, you're synchronizing with movement. This synchronization transforms trading from an intellectual struggle into a natural expression. The more you align, the less effort trading requires. You stop forcing trades because you no longer need to. You recognize that every move has a reason, and every reason reveals itself in its own time. To achieve alignment, you must first strip away interference. Interference comes from noise, both internal and external. External noise is easy to identify: news feeds, opinions, indicators, flashing signals, the endless chatter of predictions. Internal noise is subtler: doubt, greed, fear, impatience. Both distort perception. Alignment is silence, not absence of thought, but stillness within thought. When the mind quiets, observation deepens. You begin to notice subtle details that others ignore. You see how price behaves near key levels, how volume shifts before a breakout, how reactions slow before reversals. These are not predictions, They're patterns of energy flow. When your attention is undisturbed, these signals become obvious. The secret of alignment is acceptance. Acceptance of what the market is doing, even when it contradicts your plan. Acceptance of loss, of uncertainty, of imperfection. Most traders resist the market's message because it threatens their identity. They interpret a losing trade as failure rather than feedback. This emotional resistance creates disconnection. The market is like water, flows effortlessly around obstacles. When you resist, you become the obstacle. When you accept, you become part of the current. Acceptance doesn't mean passivity, it means clarity. You're not surrendering control. You're aligning your behavior with what's real instead of what's imagined. Flow exists on multiple levels: intraday movements, weekly trends, long-term cycles. Alignment means being attuned to the time frame that matches your awareness. If you trade short-term but think long-term, you create friction. If you hold positions based on noise, you create confusion. Alignment demands coherence between your mindset, your strategy, and your time frame. Each must flow with the other. A day trader aligned with the 5-minute rhythm reads the pulses of liquidity and volatility. A swing trader aligned with the daily rhythm reads the broader structure of accumulation and distribution. Both are in flow when their awareness matches their environment. When you're aligned, hesitation disappears. You no longer second-guess entries or exits because they arise naturally from observation. You don't ask, should I enter? You sense that the flow supports your move. There's a balance between confidence and humility. Confidence in your attunement, humility in accepting uncertainty. Every trade becomes a dialogue with the market, not a declaration against it. The market speaks through structure, and alignment allows you to hear its language. You begin to see not just price, but intention, where effort is being applied, where resistance is softening, where imbalance is forming. Misalignment feels like friction. You'll feel out of sync, like you're always one step behind. You'll enter too early, exit too late, and interpret signals backwards. This isn't bad luck, it's disconnection. The moment you notice friction, you pause. The pause is sacred in trading. It's the space where you reset your rhythm. Alignment cannot be forced, it must be felt. When you pause, observe, and let go of expectation, the flow reappears. The market never hides it, it's always there. Only your resistance blinds you to it. Traders often think alignment means catching trends early or staying in them longer. But that's not it. Alignment is about harmony between your internal state and the market's external state. If the market is trending and you're calm, you move with it. If the market is choppy and you're restless, you get trapped. The mismatch creates loss. True alignment means you adapt your inner tempo to the market's tempo. You learn to slow down when volatility slows and to act decisively when momentum builds. This adaptability transforms trading from a battle into a dance. The more time you spend observing the market without bias, the more naturally alignment arises. You begin to see that every market phase, trending, ranging, breaking, is just another form of energy expression. There is no good or bad condition, only compatible and incompatible states. If your approach is in harmony with the current condition, you flow. If it's not, you fight. The key is to recognize your state and the market state simultaneously. Awareness of both creates synchrony. Alignment is built on trust. Trust in the process, trust in your ability to read conditions, trust that the market's movement is an information. When you trust, you release the need to predict. You no longer chase certainty. You follow clarity. Clarity doesn't promise profit, but it prevents confusion. Profit becomes a byproduct of connection. When you're aligned, your entries and exits feel effortless because they're guided by rhythm, not reasoning. You're not analyzing the market, you're participating in it. In the deepest sense, alignment with market flow is the merging of discipline and surrender. Discipline to follow your structure, surrender to what the market reveals. It's the point where you no longer act against reality, but through it. You stop trading from thought and start trading from awareness. The market ceases to be something external to manipulate. It becomes an environment you move within naturally, like air or water. The movement becomes your guide, and every fluctuation becomes part of a larger, unfolding rhythm that you no longer need to predict, only to feel, follow, and understand. Observation replaces reaction the moment a trader stops being a participant in chaos and becomes a witness to it. Most people enter the market as reactors. Every tick, every spike, every red or green candle triggers an emotion. Excitement, fear, relief, regret. They respond to those emotions as if they were information, but they're not. Emotions are internal noise, distortions that color perception. Reaction is mechanical, automatic, driven by habit and impulse. It bypasses awareness. Observation, on the other hand, is conscious, deliberate, and calm. It sees without judgment, it listens without defense, it notices without needing to intervene. The difference between a struggling trader and a consistent one is not in knowledge or strategy, but in the ability to observe instead of react. When you react, you hand control of your behavior to the market. Every sudden move pulls your attention outward, and you lose connection with your internal equilibrium. You start to chase what you see instead of understanding what it means. Price rises, and you buy out of excitement. Price drops, and you sell out of fear. In this reactive loop, you're not trading the market, you're trading your own emotions. The market becomes a mirror reflecting your state of mind, and every move triggers the same cycle of hope and disappointment. Reaction is rooted in survival instinct. It evolved to protect you from immediate danger, but the market doesn't operate on danger, it operates on probability. The instinct that saves your life in the jungle destroys your capital in the market. Observation interrupts this loop. Observation creates space between stimulus and response. When you observe, you see a spike in price, but you don't interpret it instantly. You watch. You notice the volume, the reaction at key levels, the pace of movement. You gather context instead of conclusions. The act of observing slows down time. It gives your mind the ability to process data without the interference of urgency. That space is where clarity lives. The most successful traders live in that space, the gap between what happens and what they choose to do about it. Observation is not passive. It's an active form of awareness. It's not about sitting and staring. It's about engaging with what's unfolding without being pulled by it. To observe is to witness the market's behavior like a scientist observing an experiment. Curious, patient, and detached, The observer doesn't hope for a result, he studies the pattern of cause and effect. He sees how buyers respond to resistance, how sellers behave under pressure, how liquidity forms and dissolves. Each observation adds to understanding, not through memorization but through recognition. When you observe enough without interference, you begin to sense repetition, not in price patterns alone, but in behavior. You start to notice how panic looks on a chart, how greed manifests, how hesitation shapes volume. Reaction kills learning, observation builds intuition. Intuition isn't magic, it's the unconscious accumulation of observed experience. When you observe without reacting, your mind records subtle details that reaction usually ignores. Over time, these details form patterns that your conscious mind can't articulate, but your subconscious recognizes instantly. That's why experienced traders sometimes describe knowing something just feels right. That feeling is the product of thousands of moments of observation without interference. It's not instinct, it's embodied awareness. The challenge is that most traders can't tolerate uncertainty long enough to observe. The moment the market moves against them, emotion floods the system. They feel an immediate need to do something, to fix, to act, to protect. This compulsion to react comes from discomfort with not knowing. Observation requires comfort with not knowing. It's the willingness to let the unknown unfold without interference. The observer understands that clarity emerges over time, not instantly. The reactor demands answers now, and in that demand, he blinds himself to the information that would have provided those answers naturally. When you're in a state of observation, the market's movements lose their emotional charge. A red candle isn't bad and a green candle isn't good. They're simply expressions of collective behavior. You watch how the market breathes, how it expands, contracts, accelerates, and pauses. You see that it's alive, not mechanical. Observation reveals the personality of the market, its tendencies and habits. Each instrument, each time frame has its own rhythm, its own pulse. The more you observe, the more you learn to synchronize with it. Reaction disrupts that connection because it replaces curiosity with judgment. Judgment narrows perception, observation expands it. To cultivate observation, you must learn to stay still while your mind screams for action. Stillness is power. It's not inaction, it's the foundation of intelligent action. When you wait, you're not losing time, you're gaining clarity. The untrained trader equates movement with progress, but in the market, movement without observation is noise. Every trade made from reaction carries hidden risk, not just financial risk, but psychological damage. Each reactive trade reinforces impulsive behavior, making it harder to stay neutral in the future. Observation breaks this cycle by creating awareness of the impulse before it turns into action. The moment you can watch your urge to trade without obeying it, you've begun to master yourself. Observation also exposes patterns in your own behavior. You start to notice not only what the market does, but how you respond to it. You see the moments you become tense, the setups that trigger overconfidence, the times you hesitate after a loss. You begin to realize that the market's behavior and your own behavior are reflections of the same underlying forces: uncertainty, fear, and desire. By observing both, you gain insight not just into price action, but into your own psychology. The goal isn't to suppress emotion, but to recognize it as it arises and let it pass without attachment. In this way, observation becomes both a trading tool and a form of self-awareness. Reaction thrives in noise, observation thrives in silence. Most traders fill their screens with indicators, alerts, and opinions, mistaking information for clarity. Observation is the opposite. It simplifies, it removes the unnecessary until only the essential remains. When you look at the market with clear eyes, you see structure, levels where decisions are made, points of balance and imbalance, areas where conviction is strong or weak. You no longer need the market to move a certain way to feel comfortable. You simply watch it move in a line when the flow confirms you're read. This detachment doesn't make you emotionless, it makes you precise. A reactive trader's decisions are driven by time, by the urgency of the next candle, the next move. An observing trader's decisions are driven by condition, by the quality of the setup, the alignment of factors, the feel of the flow. This difference changes everything. The reactor constantly feels late or early. The observer is always on time because he moves only when the market invites him to. The invitation is subtle, but it's there, in the shift of momentum, in the tone of the tape, in the slowing of volatility before expansion. You can't see those signals if you're reacting. You can only see them when you're still enough to observe. Observation also cultivates patience. True patience is not waiting passively, it's sustained awareness. It's the ability to remain attentive without forcing an outcome. Patience born from observation is alive, alert, and responsive. You're not waiting for the market to give you something, you're waiting for the market to reveal something. The moment it does, action becomes simple. There's no hesitation because the signal isn't forced, it's recognized. Trade feels natural, almost inevitable, because it emerges from awareness, not analysis. The transition from reaction to observation marks the shift from trading emotionally to trading consciously. In reaction, you're inside the storm, tossed around by every gust. In observation, you're above it, watching the pattern of the wind. The market is the same, but your position within it changes. You become the eye of calm in the center of movement. Every candle, every fluctuation, every burst of volatility becomes information, not provocation. You stop chasing certainty and start perceiving rhythm. In that state, decisions no longer come from the need to act, but from the clarity to respond. Consistency reveals direction because the market, beneath all its chaos, is never random. Every movement, every surge of price, every quiet range has intention buried inside it. What most traders see as noise is simply the unfolding of repetitive behavior at different scales. The market moves in cycles not because of magic or mathematics, but because human behavior repeats itself. Fear and greed don't evolve, they just recycle. The same reactions that drove the markets a century ago still drive them now, only faster and more visible. If you learn to identify consistency in behavior and reaction, in structure, you begin to see where the market truly wants to go. The big trend doesn't shout its existence, it whispers through repetition, through patterns that keep reappearing no matter how the conditions change. Consistency isn't about price levels alone, it's about the emotional rhythm behind them. Watch how price behaves at certain points. When a level holds again and again, it's not coincidence, it's collective belief manifesting in structure. Traders invest investors, algorithms, they all contribute to this shared pattern of response. Consistent reactions reveal conviction, and conviction is what drives trend. A single breakout means nothing if it's not supported by repeated follow-through. A reversal is meaningless without consistent failure to sustain the previous direction. The big trend reveals itself when behavior stops being random and starts being patterned. The eye that can spot that shift from chaos to order can see direction before the masses accept it. Consistency also exposes the market's psychology. Markets are conversations between participants, and every consistent move is a statement of intent. When price consistently rejects higher levels, it's not just technical resistance, it's hesitation, doubt, distribution. When it consistently makes higher lows, it's not random demand, it's quiet accumulation. The surface moves are secondary, the repeated behavior is the truth. The challenge for most traders is that they're too impatient to notice consistency. They want confirmation instantly, but consistency needs time to reveal itself. It's a slow unveiling, a pattern built candle by candle. To see it, you must step back and allow the market to speak over a longer horizon. Consistency doesn't always appear in straight lines. Sometimes it's hidden in rhythm, the tempo of pullbacks, the speed of reactions, the frequency of pauses. When a market moves with rhythm, it's being guided by a dominant force. That rhythm tells you whether energy is building or fading. You might see it in how long it takes for a dip to recover, or how quickly momentum returns after a shock. Each repetition tells a story about control. When buyers consistently step in faster than sellers can push down, direction becomes clear even before price makes a visible breakout. You don't need to predict the future. You just need to notice which side behaves with more persistence. The mind trained to find direction through consistency must first abandon the obsession with prediction. Prediction blinds you to the slow accumulation of evidence. Consistency doesn't need prophecy, it needs patience. Every major move in history has been preceded by weeks or months of repeated signs that most ignored because they didn't look dramatic enough. The trader who observes these signs, who notes that behavior keeps echoing the same rhythm, finds himself aligned with the underlying current before the breakout becomes obvious. By the time others see it, he's already flowing with it. The advantage doesn't come from guessing, it comes from witnessing repetition without bias. Consistency also acts as confirmation of integrity. The market, like a living organism, reveals its health through its patterns. Healthy trends move with balance, consistent momentum, consistent retracements, consistent volume behavior. When that consistency breaks, it's the first sign that the direction is weakening. Most traders ignore that break because they're attached to their expectation, but the market always signals before it shifts. The pattern of consistency is the pulse of the trend. When the pulse changes rhythm, something beneath the surface is changing too. Observing that shift early allows you to adapt while others are still reacting at a deeper level. Consistency reveals not just market direction, but trader alignment. The trader who behaves inconsistently cannot perceive consistency outside himself. If your process changes with every trade, if your risk tolerance fluctuates with your emotions, you become part of the noise instead of the observer of it. Consistency in execution allows you to see consistency in market structure. The clearer your own rhythm becomes, the easier it is to recognize the rhythm of the market. This is why disciplined traders seem almost intuitive. They aren't guessing, they're resonating. Their internal state mirrors the external flow, and because of that alignment, they perceive direction before data confirms it. The market never hides its intentions entirely. It repeats them in subtle ways until the pattern becomes undeniable. Volume rising at key turning points, reaction to specific zones, the volatility contracting before expansion. These are not coincidences. They are the footprints of accumulation and distribution. Each repetition reinforces the same narrative. Someone is positioning, someone is preparing. The big moves are always preceded by consistent preparation. The problem is that most traders look for confirmation too late. When the move is already obvious, the ones who train themselves to recognize consistency early are the ones who profit from it. Consistency can also be observed in failure. Failed breakouts that keep occurring in the same direction reveal exhaustion. When the market keeps testing but can't advance, the direction of weakness is being exposed. Failure itself becomes a pattern, and patterns of failure often precede reversal. Watching consistency and weakness is as valuable as watching consistency and strength. Both tell the same story from opposite sides. Consistency, whether positive or negative, is information. It tells you where the energy is flowing and where it's draining. The challenge is that consistency doesn't look exciting. It's repetitive, sometimes dull. Most traders overlook it because it lacks drama. They prefer volatility, the thrill of fast moves, the adrenaline of unpredictability. But volatility without consistency is chaos. Direction emerges only from persistence, the steady repetition of intention over time. The traders who can sit through that repetition, who can recognize that quiet persistence, find themselves aligned with the real motion long before the crowd reacts. It's the quiet observer, not the loud analyst, who sees the big trend forming beneath the surface. When you observe consistency, you're not just looking at price, you're watching behavior solidify into belief. Belief creates momentum. When enough participants start acting in the same way repeatedly, the market shifts from randomness to trend. It's the collective consistency of thousands of traders that builds movement, not any single event or data point. Each act of repeated buying or selling reinforces the structure until it becomes self-sustaining. The perceptive trader doesn't wait for news to justify the trend. He reads the market's belief in advance through its repeated behavior. Consistency is also a mirror for emotional control. The more consistent you are in reading and responding, the more you begin to notice that the market rewards balance. Sudden reactions, emotional decisions, impulsive entries, they all distort your ability to perceive repetition. Consistency in mindset sharpens observation. When you're calm, the market's repetitive nature becomes clear. You see the same behavior cycling again and again, and what once looked unpredictable begins to feel familiar. This familiarity isn't prediction, it's recognition. recognition. The pattern has revealed its nature through consistent repetition, and you're simply acknowledging it. The paradox is that traders spend years searching for systems to find direction when the answer lies in watching what keeps happening. Direction is never born from a single event, but from an accumulation of repeated responses. The market doesn't move because of one piece of news. It moves because that news is interpreted the same way consistently over time. This consistency of interpretation drives sustained momentum. If you can observe that, you don't need to predict the future. You can simply read the present unfolding. Consistency reveals truth because truth repeats itself. False moves, manipulative spikes, emotional reactions, they fade quickly. But genuine intention endures. It keeps showing up until recognition becomes unavoidable. The key is to train your attention to notice what stays constant amid change. Every fluctuation hides a pattern, and every pattern hides repetition. That repetition is the market's way of telling you where it's really going, and only the observer patient enough to see the same behavior occur again and again can read that hidden direction beneath the surface. Awareness exposes the trend because awareness is the one quality that allows a trader to see clearly without distortion. Awareness is not knowledge and it's not analysis. It's the quiet clarity of perception untouched by bias, fear, or desire. Most traders fill their minds with data, strategies, and predictions, believing that the more they know, the more control they have. But knowledge without awareness becomes noise. The market doesn't reward those who know the most, it rewards those who see the clearest. Awareness is the bridge between perception and understanding. It lets you recognize the rhythm beneath randomness and the direction hidden within confusion. The big trend is always there, moving like a current beneath the surface, but only awareness can reveal it because awareness sees without interference. Awareness is presence. It's the ability to be here with the market as it is, not as you imagine it to be. When you are aware, you don't chase signals, you don't cling to opinions, and you don't resist what's happening. You see every tick, every move as part of a larger unfolding pattern. The unaware trader lives in projection, projecting fears of loss, hopes of profit, and beliefs about what should happen next. These projections act as filters, blinding him to what's actually occurring. The aware trader doesn't need to predict because awareness allows him to recognize direction in real time. He isn't guessing, he's observing. He's not reacting, he's aligning. Awareness transforms trading from guessing outcomes to witnessing truth as it unfolds. The challenge is that awareness cannot coexist with attachment. The moment you want something from the market, a win, a confirmation, a recovery, awareness collapses into expectation. Expectation narrows your field of vision. You begin to see only what supports your hope and ignore what contradicts it. Awareness requires freedom from expectation. It's not apathy, it's openness. It's a willingness to let the market express itself fully, even if it doesn't serve your position. That openness allows you to detect the subtle shifts that others miss. The slowing of momentum, the buildup of energy, the hesitation before reversal. These signs are invisible to the mind locked in hope or fear, but obvious to awareness, which has no agenda. Awareness is also sensitivity. It's the capacity to feel the market's mood without labeling it. Every market has a tone, an emotional temperature that shifts from calm to tense, from confident to uncertain. These tones are not found in indicators, they're felt through awareness. When you're present, you sense when the market breathes easily and when it struggles. You notice when volume confirms conviction or when volatility masks confusion. You see that price action isn't mechanical, it's emotional energy translated into movement. Awareness makes that energy visible. The trend in its purest sense is simply sustained emotional direction. Awareness reads that direction without needing permission from analysis. To cultivate awareness, you must first silence the noise within. The external noise of news, alerts, and opinions is easy to identify, but the internal noise of thoughts and emotions is harder. The mind constantly comments on the market, judging, comparing, fearing, hoping. Awareness doesn't stop these thoughts, it watches them. It sees them arise and pass without becoming them. This inner watching gives you space. In that space, clarity emerges. You begin to notice that the market isn't the source of your confusion, your identification with thought is. When you no longer believe every thought, you start seeing the market as it is instead of as your mind imagines it. The more aware you become, the quieter your reactions grow, and the clearer the trend appears. Awareness has no bias. It doesn't prefer uptrends over downtrends, wins over losses. It sees both as expressions of movement. The unaware trader becomes emotionally attached to direction, cheering for bulls or rooting for bears. This attachment distorts perception. Awareness doesn't need the market to move a certain way. It simply watches which way it's moving. That neutrality is powerful. It removes the emotional resistance that clouds judgment. When you're aware, a loss doesn't shake you, and a profit doesn't excite you beyond control. Both are just outcomes within the flow. This detachment keeps you aligned with the market's rhythm, allowing you to ride the big trend rather than fight it. Awareness isn't learned, it's remembered. Every trader has moments of pure awareness. Those times when decisions feel effortless, when every move seems obvious. In those moments, you're not overthinking or forcing, you're simply seeing. That's awareness at work. But because the mind craves control, those moments fade quickly. Awareness cannot coexist with control because control implies fear. The more you try to force understanding, the further you move from it. Awareness arises naturally when you stop trying to grasp and start allowing. It's the difference between looking and seeing, between hearing and listening. Awareness doesn't seek. It receives. Awareness exposes the trend because trends are not hidden in data. They're hidden in perception. The crowd doesn't see the big trend because they're too busy reacting to short-term movements. Their awareness is fragmented, constantly pulled between fear and greed. The aware trader watches the same chart but sees the underlying coherence. He notices that certain reactions repeat. That momentum builds in one direction even as minor pullbacks occur. He doesn't interpret these as random fluctuations but as part of a living sequence. Awareness connects the dots without forcing them. It sees continuity where others see chaos. When you trade with awareness, the market becomes transparent. You begin to sense when it's balanced and when when it's imbalanced, when it's being driven by conviction, and when it's drifting in confusion. This awareness lets you step in when the flow is clear and step back when it's not. You no longer chase trades out of boredom or fear of missing out. You act only when clarity appears, and you wait when it doesn't. That waiting isn't wasted time, it's presence in action. Awareness turns patience into power because you're no longer waiting for something external to happen. You're waiting for internal recognition to align with external movement. The irony is that awareness makes trading simpler but not easier. Simplicity is clarity, and clarity can feel uncomfortable when the mind wants complexity. The mind seeks reassurance in indicators, patterns, and strategies because it fears uncertainty. Awareness doesn't need reassurance, it embraces uncertainty. It knows that uncertainty is not chaos, it's potential. The big trend always emerges from uncertainty, and awareness is what recognizes it in its early stages. By the time analysis confirms it, awareness has already seen it forming in the rhythm, the tone, and the behavior of price. Awareness moves ahead of knowledge because it perceives directly without translation. Awareness also exposes your own internal trends. The way you think, react, and behave follows patterns just like the market does. Awareness lets you see those patterns in yourself, the hesitation after a loss, the greed after a win, the fear before entry. By observing these patterns, you begin to understand that your internal state and the market's external movement are connected. The clearer your internal awareness becomes, the more transparent the market feels. The trader who knows his own tendencies can see the crowd's tendencies mirrored in price action. Awareness of self becomes awareness of structure. The deeper your awareness grows, the less you need to act. You start to see that the market reveals everything you need to know if you're still enough to notice. You no longer chase trades, you allow them to come to you. Awareness exposes the points of imbalance that lead to opportunity, the quiet transitions before movement, the consistency that defines trend. It's not intuition, it's perception without interference. The aware trader doesn't need to prove anything to the market because he's no longer separate from it. He moves with it, sees through it, and understands that the trend is not something to find, it's something to recognize through the lens of awareness.